industry experts who will give you insights into some of the emerging issues that they are identifying in their own preparation towards IFRS 17. We will then have time for a question and answer session, and in that session you'll be able to provide questions to the experts, and we'll have about half an hour at the end to answer that. So those who do want to answer questions, you can enter them by sending a message to the host, ourselves, Insurance Europe. We should be at the top of your WebEx web page, and if you click on and you left click, I think you can select chat and send a message with a question. You can do that at any time, but the questions will be answered at the end unless there's something which we feel really warrants some attention during the course of the presentation. So the speakers today, in addition to myself, Olaf Jones, we have Harm van Meerendonk, we have Massimo Tassoni, we have Joe Klug, and Patrick Bosch. These are experts from European insurance groups, and they will be introducing themselves in terms of their role and their relation to the IFRS 17 work in their companies. But many of these experts have been involved not only now in the implementation, but also in the development of IFRS for many years. Just a brief introduction to Insurance Europe for those who may not know us. We are the European Insurance and Reinsurance Federation. We were founded in 1953. We represent 95% of European insurance market by premium income, and we cover all forms of insurance, life, non-life, reinsurance, and mutuals. And our purpose is to represent the industry through our members to ensure efficient and effective regulation and supervisory framework at European and international level. We have 35 national associations, so that covers almost every one of the EU member states, the wider EU EEA region and Switzerland, and also we have associate members and one partner. So overall, we are very representative of the industry, and we work through our members who are the national associations in each of the countries. But collectively, we are very important to the European economy, in fact the world economy, because we are actually very active worldwide, even beyond Europe. But within Europe, we have 35,000 insurers. We generate 1.2 trillion of premium income. We employ nearly 1 million people, and we invest over 10 trillion into the European economy. Now, moving on to the objectives for IFRS 17, which is why we are here. We come from a IFRS 4, and one of the challenges with IFRS 4 is that there are IFRS 4 phase 1. There were various different measures used across Europe, and one of the key aims is to ensure a common model for all types of insurance contracts, leading to increased comparability across insurers. Another aim is for increased transparency on the performance of insurers, to align insurance accounting with other IFRS standards in the framework, to focus on the reporting of risks and uncertainties, and also focus on the reporting of performance drivers which are useful and relevant for insurance business. In terms of who are the users, I think around the world we see a total, according to the figures of the IASB, 626 listed insurance companies, and of those 449, so majority is applying IFRS standards, and just over half in terms of assets. In terms of European usage, it's worth noting that Europe accounts for 95 companies, but nearly half of the total assets represented by those applying IFRS. However, within Europe, actually, while the use of IFRS for listed companies, consolidated reporting is mandatory, the actual requirements go beyond that, and so the number of companies affected is much greater, and that also means that a lot smaller companies are affected than would be normally expected if this only applied to listed companies. So first of all, unlisted consolidated groups need to apply IFRS in nearly half of all European member states. And in fact, even for statutory reporting, nearly another 43% is mandatory and allowed for another 32%. So a significant number can be using IFRS. And similarly, there's also usage even for unlisted statutory reporting on an entity level. So it can impact tax and dividend payments across a number of member states. And as I mentioned, that means that many more than the listed companies are actually impacted. In terms of IFRS's key changes, I think many of you will be familiar with this, but I think it's worth touching on because it is ultimately leading to both the ultimate benefits of IFRS, but also some of the challenges, particularly in terms of implementation, but also in terms of ongoing maintenance of the IFRS 17 framework, which is going to be introduced together with IFRS 9. So I think the first big difference is the way profit recognition will change with the introduction of both a formal risk adjustment, the discounting of future cash flows with everything at using current estimates, and the inclusion of the unearned profit, which is referred to as the contractual service margin, or the CSM. This brings a range of implementation and operational challenges. First of all, the CSM amortization is in the basis of coverage units. That means these coverage units need to be defined. The CSM amortization needs to be also defined, and a number of methodologies will need to be developed, and this includes a discount rate, the valuation of options, and the risk margin. The presentation of the P&L will also be changed in a fundamental way. In particular, for example, instead of representing income based on premiums, less premium ceded, the income will be now based on the insurance contract revenue, so more based on the direct fees, and that leads to a range of other significant changes in the way the P&L is measured. That will involve a challenge in both mapping the different the accounts, but also, of course, in explaining the changes to the users. And of course, companies will be involved in that, but already the IASB is reaching out and taking a number of steps to prepare the market for that, and of course different companies are taking action with their own investors. The other basic and key change is the move towards three general approaches in order measurement approaches, and they start with the general building block approach. Then we have the premium allocation approach and the variable fee approach. Here the challenge will be to identifying which contracts are eligible for which treatment for the premium allocation approach, and the scope of the VFA approach will be another issue companies will have to deal with, and is one of the key issues we'll be touching on later. The level of aggregation has been a huge element of discussion throughout the development of IFRS 17 and remains an area which is receiving a lot of attention during the current testing, and again that will be touched on a bit later. But there are a number of different ways in which the aggregation will be driven. Partly will be driven by the type of similar contracts, or typically products. It will also be driven by the need to divide your contracts into those which have no significant risk of being onerous, in other words, are profitable and expected to remain profitable, those which are onerous, which are basically therefore unprofitable, and those in between which are profitable but could become unprofitable at some stage. In addition to that, there is a need to divide the contracts into annual cohorts, and which has been another key element of discussion. One of the key issues many of the European insurers will be looking at is to what extent IFRS 17 and Solvency II are linked, in particular when it comes to both implementation but also to explaining the balance sheet and the movements to the users and of the accounts, and for internal management purposes. It's important to note that while there are some conceptual similarities, and indeed there are the basic idea behind both measurement systems is quite similar, they are not the same, and indeed there are some important differences. Some are known already, and some will become clearer as companies develop their methodologies and they are to a large degree in the process of looking at these issues now. But we highlight here on the slide 14 some differences between IFRS 17 and Solvency II. These are by no means, this is not meant to be exhaustive, but this includes the way in which contracts are recognized, the way in which the measurement model can be different. The discount rate methodology is, for example, defined in a much more greater detail in Solvency II than it is under IFRS 17. The contractual service margin is something which eliminates day one gain under IFRS 17. There is no directly similar concept within Solvency II. The allowance for risk is again left more open than in IFRS 17 than in Solvency II, where IFRS 17 being more principle-based in that respect. And finally, the other comprehensive income, which is again something which IFRS 17 has, and there's no direct similar concept within Solvency II. In terms of understanding the overall process we're going through, we start here with 2017, but it's worth pointing out that the story and the timeline really started 20 years before that in 1997 with the start of the whole project, and then developed through IFRS 4 Phase 1, and now we're in the culmination of what was originally called IFRS 4 Phase 2 with IFRS 17. But our story starts with the publication of the standard in May 2017, and is due for completion once companies have to provide their first annual accounts in 2022. So based on this planning, in terms of the process within Europe, we first need an endorsement of this standard before we are required and in fact can apply it. And that endorsement process is currently underway with endorsement advice requested by the Commission at the end of 2017 to EFRAG, the European Financial Reporting and Advisory Group, who advised the Commission on all matters relating to IFRS 17 standards, both their implementation but also the need for improvements and change over time. And their deadline, they were given a deadline of the end of 2018. This is one of the most extensive set of endorsement processes they've had to run, because IFRS 17 is a huge change to the previous standard, and therefore needs a consequently significant time for them to assess the advice. After that, the exact timing is not yet known, but sometime between 2019 and 2020, the Commission, together with will need to come up with their endorsement decision, and then in a moment we'll see the next stages in the process. I think it's worth saying that that in terms of from a company point of view, as I mentioned, this is a very significant project. It will impact their accounting reporting, their modeling, their data and systems, processes and controls. It will take a significant effort to implement and after that to operate. And we mentioned before there was, from some parts, a hope that the Solvency II work would reduce the burden significantly, and there will be some benefits and obviously advantages that can be taken from the work already done. But because of the differences, you shouldn't maybe overestimate how much can be leveraged from Solvency II. So a significant additional work will be needed. And typically companies will be going through a process of pre-assessment currently, and that in many cases will already be done and was already started during the development of IFRS 17. They will be going through a process of impact assessment, design, build, test, and obviously build adjustments before going live. Different companies at different stages in this process, but obviously all should have started this process in order to reach the end on time. In terms of the endorsement process, that will confirm that we will go ahead with IFRS 17 within Europe. I mentioned before that we have the advice from EFRAG. The Commission will then give their proposal. Then an accounting and regulatory committee, which is made up of the EU institutions, including European Parliament and Council, will give their views. And finally, the Council and Parliament will have a 3-month process for scrutiny when they can decide either to accept the advice or to reject the advice coming from these institutions. And all of that must happen, of course, well before the deadline. But we know from past experience, even IFRS 9, the process did take quite some time. Now, in terms of the EFRAG advice, the Commission has given them a range of factors to take into consideration. Obviously, that starts with the purpose and the need for IFRS 17, whether or not it, in their opinion, will deliver on those objectives we mentioned before. They've also asked them to look do an impact assessment which covers a variety of elements, including the impact of competitiveness, the representation of the business model. They will be looking at comparisons between Solvency II and IFRS. They'll be looking at the impact on the overall sector, etc. That has led to EFRAG to have a number of work streams in order to fulfill all of the requirements set by the Commission. That includes a full case study, which is involving 11 companies, I believe, and that is a very extensive case study looking at a significant amount of quantitative data. They will, of course, be looking at qualitative data as well, but given the level and intensity of work required, that was limited to 11 companies. In addition to that case study, EFRAG have developed a simplified case study, in which we'll talk about in a moment, and that is basically intended for everyone else. In addition to these case studies to provide information in order for them to answer the questions and provide advice, EFRAG are carrying out a number of other studies and work, including an economic study, a user outreach program, and they're also looking at IFRS 17 and Solvency II comparison as a separate project. Now, focusing on the EFRAG simplified case study, the purpose of this is to gather information from insurers that apply IFRS standards but are not taking part in the full case study. This will be used to provide information into a draft endorsement advice, and it's worth noting that they will consult on that draft endorsement advice sometime around most likely late September, possibly early October, where the industry and all other stakeholders will have an opportunity to provide feedback on their draft advice. Any data that's provided from companies to EFRAG for this simplified case study will be treated confidentially. Partial submissions are accepted. They really would like to maximize the number and range of contributors. The deadline is the end of May 2018. All input received will be aggregated with input from other sources and responses in order to help EFRAG form their opinions. And the simplified case study can be found on the EFRAG website, when we will make this presentation available, and you can find the link, but you can find it also very easily from their website. The Insurance Europe and its member associations are encouraging insurers to take part in this simplified case study to ensure that EFRAG has the input from a wider range of companies as possible and is therefore aware of all the key issues and concerns. Ultimately, our interest is to make sure that IFRS 17 is suitable for its purpose and that issues are identified and, where necessary, resolved. In terms of this simplified case study, it's divided into 2 parts. Part A is qualitative and asks a range of questions in terms of the impact, in terms of costs, the pricing impact, They ask about product trends. They will ask about the impact on asset liability management. They will also ask a series of questions, or they do ask a series of questions around the benefits of IFRS 17, covering a different elements of IFRS 17 and how it affects your accounts. Again, I would emphasize that partial answers are accepted. In fact, EFRAG recognizes that some companies will only be able to submit Part A, this general information, even that not all of this general information may be possible to complete, although obviously as they would encourage and desire as complete answers as possible. It's worth noting that in the section on benefits of IFRS, this is also the area where potential problems with IFRS can also be identified. Typically, they ask questions with a scale 1 to 5, whether or not certain benefits would be achieved or far from achieved, but depending on how the questions, and they also ask for examples or commentary on the response. This can be answered separately from Part B, which I'll cover briefly now. Part B is the quantitative part and includes a number of steps in order to identify the right portfolio, in order to then focus the quantitative analysis on that portfolio. Again, partial answers are accepted. EFRAG recommends or asks for one insurance portfolio to be selected, and then basically for the standard to be applied, and obviously either in a full way or in an estimated way, and from that for the company to report on the different elements, and most of which are listed in this slide. At this point, this completes the overall introduction for IFRS and the process by which the endorsement will take place, and in particular the EFRAG simplified case study, which, as I mentioned, we hope many of you will be taking part in. And I now pass over to Harm van Meerendonk from the NN Group to introduce himself and also to provide a general presentation, and later on he'll be providing some specific input views on hedging. Thank you.
Yes, thank you, Olaf. Can you hear me well?
Not extremely well, but
Is this better?
That's better, thank you.
Yes, let me try to do it like this then. Yes, maybe to quickly introduce, I'm Harm van Meerendonk. I'm responsible in NN Group for the financial reporting at the group level of NN. But one of the main reasons I'm speaking here to you is that I also coordinate some of the activities in the CFO Forum in the working group that's focusing on IFRS 17. So if we could go to the next slide, maybe for or the slide up, yeah. Maybe for those of you who are not familiar, what we call the CFO Forum is a sort of a discussion group that includes 21 of the largest.
Harm, sorry to interrupt. I think you need to keep very close to the microphone. Apologies.
I'll try to do that.
Oh, that's much better.
Yes, I'm sitting rather uncomfortably now, but I'll try. So, as I explained, the CFO Forum is a discussion group of the larger insurance companies in Europe. We basically have 21 members that represent large, mostly listed IFRS compliant insurers in Europe. And we cover discussions in a number of areas, including IFRS reporting. The history of getting to IFRS 17, as Olaf mentioned before, is relatively long, and the forum has been involved in that alongside the development in IFRS 17. So there's been lots of involvement of the forum in the establishment of IFRS 17. And that also means that we have members in the forum that have been involved for quite a long time in the development. And some of our members will be talking later in this webcast on specific individual topics. At the moment, different members of the forum are involved in several ways in IFRS 17. Of course, individually in the member companies in implementation projects, where a number of our members, mostly by now, have kicked off implementation projects, so are working with the standard in terms of implementing. At the same time, we have a few members who are involved in the EFRAG case studies, a smaller number of members in the extensive case study. The one was mentioned that really goes into the details of testing the standard on selected portfolios. And most of our other members are working on the more limited case study. So overall, almost all of the members of the forum are involved in either of the two EFRAG testing exercises. Then next to that, we have amongst the members in the forum a number of working groups that are focusing on different elements of IFRS 17, where we are discussing the interpretation but also issues coming up, and to either see whether we can get to common views there or whether we can take the issues broader into some of the other activities. And finally, a number of our members are also member of the IASB Transition Resource Group. And again, there is a link between the testing and discussion work we're having within the forum and the topics that are being discussed in the IASB. So here you can see that the combination of the work going on at the moment and the history of being involved in the standard means that a number of our members are quite into the detail of the standard, and that's also why they will be presenting later on after my introduction on a number of the specific topics and the issues we are seeing there. In all of this, we are seeing a number of areas where IFRS 17 still is to be interpreted further, or where issues are coming up that we think are important, that are being discussed further, and also are still being considered in the endorsement process and or in potentially still amending the standard before IFRS 17 can work as it is intended. We'll get back to these issues in a minute, but we are in the process of collecting these issues to make sure that they are known and being addressed. And that's also why we want to give an overview of these here, so that each of you in participating in the discussions and the EFRAG case study sort of are aware of the topics that are being discussed in the forum and can take these into account. There's a few sort of caveats before we go to this list of issues. Of course, it is always difficult to come to issues that are equally relevant to each of the jurisdictions or each of the members. So what we are looking at in a minute is sort of issues being gathered that have different importance to different companies. And therefore, it is also a list of issues not in a specific priority order. But we do think that these sort of are a good summary of the discussions currently being held within the members of the CFO Forum. I will quickly introduce these topics, not in a lot of detail, because each of these will be dealt with in more detail by the speakers following me. But just to provide you an overall summary before we go into the more detail, I want to just run through the topics one by one on the following slides. On this page you see two. First is on level of aggregation, so that's the grouping of contracts and the level at which contracts can be grouped together in accounting. And the two specific elements to mention there. One is the requirement to take contracts on an annual cohort level, which means that basically every year of production forms a new group, and that continues to build up, resulting in multiple groups of contracts by year of issue, which is of course in terms of operationality quite complex, and also means that contracts issued in different years cannot be grouped together, impacting the sharing of the results over those contracts. So typically an issue of complexity and at the same time also impacting the outcome. And on top of that, there is restrictions on grouping contracts by different components. Again, here leading to requirements to separate contracts that, in terms of management of the portfolio, should belong together. Again, more details will follow with the following speakers. Second topic we have listed here is the amortization of the contractual service margin. A very complex area where the service margin, so the profit in the contract that is deferred and recognized over time, needs to be released in a certain pattern based on the so-called coverage units. And here I think the issue is a combination of two things. One is that the definition of the coverage unit is quite complex. And at the same time, there are examples where the pattern of the release of the profit is not in line with what you would expect based on the underlying economics. And this release pattern is quite fundamental, driving the profit release over the terms of the contract. So quite important to get this right. If we can turn to the next slide, two more topics here. One is on reinsurance, which effectively is a combination of quite a few more detailed issues. But if you bring them all together, then to get the economics right of reinsurance coverage to the way it's reflected under IFRS 17 has a number of issues still. And especially here, the key issue is to get the consistency between the accounting of the underlying insurance contracts and the model covering the reinsurance coverage. Is quite a complex area, and also an area where the understanding and the interpretation is still developing. And you see a number of examples of basically mismatches between the accounting for the underlying contract and the reinsurance contracts. Another topic on this slide is about transitioning, and I think one that is very important not to underestimate, because typically for insurance business, a large part of both the implementation and the financials going forward is driven by the existing in-force contracts, where the choices being made on transition can very significantly impact the results going forward. And at the same time, simplifications are needed to be able to transition to IFRS 17 for the in-force business, where the principle of applying IFRS 17 fully backwards to the oldest contract is of course practically impossible. But then at the same time, the practical experience that are in the standard to transition in a more simplified way are still very constraining, and at the same time may impact the results in the future quite significantly. So I think typically an area where we should watch very carefully for the trade-off between what is possible what is allowed, but also what the impact on the results going forward is. Then I would say a very different topic, or topics that we have grouped together under presentation, is that you will see that there are quite some requirements in IFRS 17 that are sort of have in common that it is about presentation, so less the driving the net result, but more the way these need to be presented, which are very much impacting the operational complexity of implementation, and are really driving part of the effort to implement the standard, whereas you could argue whether they really add to the outcome itself. These are examples like balance sheet presentation of insurance contracts that are asset and liability positions. This is about the requirement to separate investment components. It's about the treatment of premiums and claims payable, receivable. So I think the key issue here is that there is a number of elements that drive complexity quite intensively without, in our view, too much benefit for the users in the end. VFA mentioned before, the scope of the VFA in two aspects still an issue. One is the scope of the VFA, so to see what qualifies and what does not qualify for the VFA, where there is still a significant grey area of product yes or not qualifying. And that means the variable fee approach was developed because it's needed to get the correct answer in terms of accounting, reflecting the substance of quite a few common insurance products. So you need the variable fee approach to get the right accounting answer for these products. And at the same time, the scope is in certain areas restricted. So what we see is that there are products potentially not qualifying for the variable fee approach, which gives you quite a different accounting answer than if they would. Then finally, on the final side of the topics, one is about acquisition costs. That's technically a simpler issue, but for certain products quite important. This is where acquisition costs are effectively being paid over the longer term, so earned back over products that include renewals. So you pay acquisition costs assuming that products are being extended or renewed, and the standard requires you to amortize the acquisition costs over the insurance period for the shorter one, which may lead to onerous contracts that economically are not. And finally, what we have labeled under hedging, which is where hedging is being applied to cover certain risks, but the accounting requirements do not allow you to reflect that in the accounting in a number of areas. Again, as I mentioned at the beginning, this is a list of the most significant or the most commonly identified issues. To be honest, there are many more, but those are either the less significant or more specific issues. But we think these are the key ones, and sort of on each of these we'll go into a bit more detail in the following sections. So again, it's probably good to look into the following sections with the further explanation, and then if you have questions, we can take them on the end. So here I would pass over to the following speakers to go into a bit more detail.
Good afternoon, everybody. It's Massimo Tusoni speaking. Can you hear me?
Yes, thanks. We can hear you.
Okay, so thank you. I'm the head of group accounting policies and reporting for Assicurazioni Generali, and let's say I'm leading the IFRS 17 initiative for the group, and at the same time I'm a transitional resource group member, so I can follow directly all the technical debates that are currently at ISB level. Just to give you a few reference about where we are in terms of implementation, our group carried out an impact assessment last year in 2017, so now we are running our implementation program, and in parallel we are also participating to the full EFRAG case study, because as you can imagine, this is a key milestone for us, and so it's very important to provide the results by the time frame is identified by EFRAG. I would deep dive two of the issues introduced by her. The first is related to the annual cohorts in the level of aggregation, and the second is the contractual service margin release. That are two fundamental areas of the standard. Let's start with the first. As also Olaf introduced, let's say level aggregation is one of the key challenges of IFRS 17. It's a quite new requirement also compared to current valuation for solvency purposes, for accounting purposes, and in particular IFRS 17 requires to run the measurement of the insurance contract, grouping the policies according to three different drivers. The first, that is the one which we are more familiar with, is the portfolio, so grouping the contract according to similar risk, and if they are managed together. The second is looking at the profitability or onerosity of the contract, and so we will end up with the three groups touched at the beginning of the call, so onerous contract, profitable but with the risk of becoming onerous and the rest. And the third driver is the so-called annual cohorts grouping. So policies cannot be grouped if they are issued in 2 different years. Especially in terms of industry, we identified in these requirements a lot of operational burden, because it's something completely new that is not present under our Solvency II process or the accounting process, so it's something that has to be implemented. And let's say it's not, in our view, fully consistent with what is the frequency of pricing of our insurance contracts. So this practical experience introduced by the IASB in order to avoid to average contracts that have a different profit seems not to be consistent with how effectively the business is priced and managed. More than this, we think that this requirement is also in contrast with some particular portfolio, in particular the participating contract, where we have a different generation of contracts relying on the cash flow coming from the same fund of underlying items. So it's the case of open portfolio for participating contracts, where that are characterized by a mutualization of the release coming from the underlying financial instrument, and this requirement to track separately the annual cohorts is leading to a sort of artificial and costly reallocation of the financial result of the sum of the fund in the different groups of contracts. What is, let's say, the preliminary suggestion in order to avoid and to override the annual cohorts? So one of the suggestions for an improvement is to override this layer, especially for these kind of contracts, these participating contracts, allowing to having a group that is reflecting the mutualization of the different generation of the contract. We think that allowing to this improvement, so this override of the annual cohort is not in contrast with the recognition of business that is loss-making. It will be anyway reported as a loss if written on onerous basis, and on the other hand to have representation of the performance of our business, of our participating business, that is more aligned with the asset liability strategy of our participating funds, that is not based on single cohorts, so subdividing the fund in different cohorts, but let's say to ensure that the overall fund is able to cope with the obligation of the policyholder, regardless the generation they are belonging to. I would move on to the second topic, that is the contractual service margin amortization. As also anticipated, contractual service margin is one of the key areas of IFRS 17 for measurement purposes, but also to recognize the profit during the life of the policy. And is expected to be one of the major fund of the revenue lines and of the bottom lines in the IFRS 17 context. The IFRS 17 requires to recognize the contractual service margin over the coverage period in accordance with the level of the service provided during a particular period. And the way it is addressing this objective is with the use of the so-called coverage unit. Each entity should identify which are the coverage units belonging to a particular group of contracts, and then allocate a part of the contractual service margin during a specific period, looking at the coverage units effectively provided during that period. The definition of coverage unit is not completely clear. The IFRS 17 is referring to let's say to the quantity of benefit on one end and the duration of the benefit on the other end, but let's say without identifying particular or specific or prescribed specific driver for that. Which are the concerns that the industry has so far detected under this area? First of all, the fact that it seems that this coverage unit definition is suitable for contracts where only insurance services are provided, but it's not fully consistent in other contracts where insurance services are provided in combination with investment management services, for example. So we are talking about, especially on contracts belonging to the variable fee approach, but not only. We can have also contracts outside the variable fee approach scope that have similar characteristics. A second area of concern is related to the fact that it seems that this coverage unit application may lead to a linear recognition of the profit during the coverage period, also for some contracts that are working with a level premium, with a regular premium, and have investment management services that instead may increase with the increase of the asset under management, and for which it would be preferable a different pattern of the profit rather than a linear one. Which are, let's say, under this aspect, suggestion or potential action in order to eliminate part of the concern. First of all, to clarify that in contracts where we have a combination of insurance services and investment services, is the total life of the contract the period under which the contractual service margin should be recognized, even if the coverage period of the insurance services is shorter than the overall contract life. So this is something that has been made quite clear and will be also object of a specific discussion in the next meeting of the TRG. There is a specific paper on this. The second is related to the drivers that can be identified in order to run off the contractual service margin. Let's say in this case, we expect that the insurer may have some flexibility and judgment in selecting which are the most suitable drivers in order to represent properly the profitability of the contract, even if they are linked to the asset under management, for example, for participating contract, or let's say reflect expected cash flows of the contract. That's all, I guess, for these two topics. I'm at disposal of any question, and I leave the floor to the next speaker.
Over to you, Joe from Aviva.
Hi, it's Jo Klube from Aviva. Can you hear me all right?
Yes, very well indeed, thanks.
Great, okay. So I'm the Group Technical Accounting Director at Aviva, and I'm heavily involved in our implementation program for IFRS 17, and I'm running the work that we're doing on EFRAG field testing. So I'm going to cover two of the topics, reinsurance and transition. I actually put my slides at the order of transition first, because I think of the two, probably it's the more straightforward, and I think reinsurance always gives everyone a headache. So if we go on to the next slide, I'm going to talk about reinsurance. Sorry, I'm going to talk about transition first. So IFRS 17 is quite unique as a standard in having more flexibility than most around transition. However, it's still very problematic. So I've put together a bit of a decision tree diagram here just to try and illustrate what we're required to do on transition. It's clear that the standard needs to be applied retrospectively from the transition date, and where it's practicable to do so, you should use the fully retrospective approach, and where you're able to demonstrate that it's not practical or the impracticable test, you've got a free choice of applying a modified retrospective approach or a fair value approach. Now, I think certainly when I've been explaining this to internal stakeholders, it's important to understand that for every market and within each market, the product groupings of contracts that we have, you can choose and you must assess each one of these individually when you're determining what you do on for your restatement. So you could, for example, choose to restate. We may choose one block of business in our UK business to do fully retrospective for 5 years. Another block we might think we can only do that for 2 years. It's very much dependent on the information that you have available. So a key first step is understanding what data you have available and what are the sorts of hurdles that would make it impracticable to restate on a fully retrospective basis. And I know some of our businesses are more advanced than others, but it requires quite detailed investigation in conjunction with the data colleagues to understand how far back you're going to need to restate. I think pretty much everyone would accept, I believe, that by 2019 you ought to be able to restate on a fully retrospective basis, because you should have had enough time from the publication of the standard in order to be able to collect the data that you would need. I think for many people, they think, yes, 2018 we'll be able to collect the data that we need to do on a fully retrospective basis. As you go earlier and earlier, it is very much dependent on the individual circumstances of your company and the data available. So once you've established when it's not practicable, and that is typically things like the data is not available, you maybe have the cash flows, but it's in old models that don't run in your current environment. You didn't apply a risk adjustment, and you don't know what decisions would have been made, so you've got to use the benefit of hindsight. So if you've got hurdles like that, you're into a free choice between a modified retrospective approach and fair value. Now actually what most people I think are seeing as the modified retrospective approach isn't particularly helpful. You still need to have actual cash flow data. You are able to use any reasonably supportable assumption, but unless you've got actual cash flows, strictly you're not within the modified retrospective approach. Therefore, the alternative is the fair value approach. Now, operationally, the fair value approach is appealing. There's no requirement to split your back book into annual cohorts, and you're able to come up with a value that's based on market values. I think the important thing to note is you've got to be compliant with IFRS 13 fair values, and therefore you've got to have a robust process around your fair value methodology, and you've got to demonstrate that you have been able to calibrate that fair value to market transactions aligned with the principle of knowledgeable willing parties in an arm's length transaction, the IFRS 13 principle. So I think the challenge with a fair value approach is it's operationally quite straightforward, but the problem you've got is that it's very subjective. There's risks that there will be more transactions or potentially some less favourable valuations close to the time of transition, and you could be forced to calibrate to that. So whilst there's a lot of appeal around a fair value approach, it's also got risks associated with it. And I think probably you're going to have your fair value methodology is something that you would need to be happy that would work group wide. So those are the choices, but I don't think there's any alternative other than to work through business by business, product group by product group, to figure out what data is available, and therefore on that basis decide for what period must you apply the fully retrospective approach, and for what periods are you then into free choice between modified retrospective and fair value. I think if you just want to go on to the next slide, we have done quite a lot of work, I think, in terms of looking at the financial impact versus the operational impact. It matters a great deal, particularly if you're a live business, to the numbers that you're going to report for the next probably 15 to 20 years. Getting the adjustment and the opening position on your contractual service margin, getting that right has a high financial impact to your numbers going forward, and potentially also to your net assets or your overall group equity. We had hoped that the operational impact of the modified retrospective approach would be lower than a full retrospective, but at the moment we're not really finding that, and I think there's many others that I'm hearing are in a similar place. And as I said, the fair value approach is definitely much simpler to do, but there remain risks, and actually getting a fair value methodology that gives you a number that you think is sensible and avoids a distortion in your profit trend just because of transition is a challenge. In terms of where do we see there could be improvements to the standard? I think in particular around the modified retrospective approach. If it's not operationally significantly easier to do than the full retrospective approach, you know, that just doesn't feel like the right answer. So I think we do believe that there is, to make it worth having, the modified retrospective approach needs to be simplified. And I think in particular the key area where the IASB really need to simplify that is around the requirement to have actual cash flows. Because if you were allowed to make some assumptions around the projection of the cash flows, which you could demonstrate would be materially correct, that would make that approach much more palatable. So, but it's an area that requires a lot of work, a lot of detailed investigation across all markets, and it's important to do that quickly in order to try and assess the scale of the challenge in restating your opening balance sheet and to try to understand the resources and the cost of the program to restate your opening position. So I think that was all I wanted to say on transitions. So if we look at reinsurance. So reinsurance is an area where, as more and more companies start to look at the requirements of reinsurance, I think more and more people are becoming increasingly concerned. Now, I can understand why the IASB got to with where they did on reinsurance, because they took a view that a reinsurance contract is a form of an insurance contract, and that whatever applies to insurance contracts generally should also apply to reinsurance contracts. And you can see as a standard setter the conceptual appeal of that, because what you're trying to do is drive consistency, and you want to make sure principles are applied consistently. I think the problem with that approach is that reinsurance is really a form of hedging in a way. It's a way of managing your risk and managing your capital, and that's why, as insurers, we tend to report and think and measure reinsurance on a net basis, and we account for it on a look-through basis, as you know, particularly for proportional reinsurance, where we have done a quota share. Our perspective is that we have given away 30, 40, 50, whatever % of each individual contract. Now that is not how the standard requires us to account for it at the moment. It says, no, what you've done is you've created a new insurance contract, and it's got a separate unit of account, which is probably the treaty, and therefore you can't do the look-through approach. That gives rise to quite a number of problems. It results in mismatches, and you potentially get a situation where the direct business that you're reinsuring is eligible for the premium allocation approach, whereas the outward contract is a building block approach. And therefore, when you're trying to have your underlying and your reinsurance assets, you're getting mismatches there. Now, there's I mentioned the point around risk. Whenever we write a reinsurance contract, we've actually laid off that risk, and so economically, my view is that we've made the net result is economically the profit or loss that we've made, whereas IFRS 17 is requiring us to report gross, and therefore we've got a day one loss potentially, and the day one gain we can't offset against that. We need to recognise that going forward. from my perspective, that's not reflecting the economic substance of the transaction. There's an issue around contract boundary and coverage period. If you've got a reinsurance treaty, and particularly if it's a reinsurance, an internal reinsurance where you're reinsuring from one entity to another within the group, which is a common way of managing capital. And a typical reinsurance treaty is, say, open for 3 years, and it accepts the new business as it is written. That means you've got a reinsurance contract with a longer contract boundary, and that covers contracts that have not yet been written or recognised by the cedent. So once again, you would be showing a mismatch where the reinsurance asset would reflect reinsurance cover for contracts that have not yet been written. And you've also got the very significant operational problem in that we're just not used to estimating the amount of new business that is going to come on that's not yet been written. So there's going to be a lot of assumptions around what the expected new business coming under the treaty is, and measuring that. And it feels like a lot of work and not useful information that we're providing. There is an issue if you are reinsuring VFA business, because VFA, the variable fee approach, is simply not permitted for a reinsurance contract. So once again, there's a difference in the measurement of the underlying and the reinsurance, and so once again that's creating a mismatch. Apologies, there's a typo here. It should say unit of account different. So this is the situation where the reinsurance contract itself is the level of aggregation, and very often a large treaty will be a unit of account. So you'll have a different unit of account between the reinsurance contract and the cedent. And you've also potentially got the issue that you might actually have more than one annual contracts from more than one annual cohort making up the unit of account in the reinsurance contract. And so once again, lots of operational complexity there to identify the contracts and where they're going, and mismatch issues. In terms of improvements, where we think there's a need for improvement in reinsurance, I think it's clear that it has just not been well thought through, the approach in reinsurance. It's not been tested, and when we have started to test it, we're seeing that it simply doesn't reflect the economics of our business, and there's huge complexity resulting in information that is harder to understand. So our view is that the current back-to-back accounting for reinsurance, for the reinsurer and the cedent, works well, and we should be able to continue to use that and continue to have the look-through approach. Our view is that it's preferable to report risks on a net basis, because that is actually the risk that the entity is exposed to. And I think there's really an important principle here. It's in some ways it is akin to hedge accounting, but the point about reinsurance is there is a very direct and contractual link between the reinsurance contract and the underlying contract. So it's hedge accounting for derivatives and so on is allowed in circumstances where you can demonstrate that there is linkage. With a reinsurance contract, it's very clearly contractual and linkage, and therefore we think it's important and right that it should be accounted for in that way and not separated. And it's clear that the operational complexity for reinsurers, for cedents, for businesses where there's internal reinsurance, it's extremely onerous. A lot of additional measuring the same thing in a different way is going to be required, and the outcome is information that, in my view, is less useful. So I think I'd really encourage people to look at their reinsurance arrangements, to look at some of these points, and to raise them with EFRAG. Because even if you're doing the simplified case study, there is an opportunity to add some qualitative comments. So you don't, if you can, and we will be seeking to demonstrate these points with some numbers, but there is an opportunity also to provide qualitative information. And I think, where possible, as many people as possible should be making sure that the key points that they're observing and that they know about, they should raise, even if they've not had the time or the capacity to actually be able to model those. Obviously, modeling and giving numbers is really helpful, but it's really important to raise the issues even when that's not available. So I think that was all I wanted to say on transition and reinsurance.
Thank you very much, Joe. And now we're over to Patrick Bosch from Allianz.
Hello, this is Patrick speaking. Can you hear me?
Yes, we can hear you very well. Thank you.
Okay, thank you. So my name is Patrick Bosch. So I'm a accounting policy expert for Allianz Group. So I'm responsible both for technical insurance accounting in the accounting policy department, and I'm heading the accounting policy work stream of the Allianz IFRS 17 implementation project. Just a little bit about the project. So we have started actually with our implementation project already in 2016. So and it's now well running, and yeah, it's quite a task. Perhaps we can now move into my topic. So will go into a bit more detail with regards to presentation issues, issues around the scope of the VFA, and also insurance acquisition cash flows. Good. Let's move on to presentation. So what you see here on the slide is a kind of a comparison between today's balance sheet of a P&C insurer and tomorrow's balance sheet, strictly for insurance line items. So what you can see today is you have very different or several different balance sheet items for insurance contracts. You have, in the case of P&C business, you have an unearned premium reserve, you have loss reserves, you have insurance payables on your liability side, and you have on your asset side, you have deferred acquisition costs and insurance receivables. The very difference now under IFRS 17 is that this split up into different balance sheet items is no longer allowed. You would be required to present insurance contracts, a group of insurance contracts that are in an asset and a liability position separately. So you would move or merge all these different positions into one single position per group of insurance contracts. So that, having said that, if all these positions would be in a liability, all these groups of contracts would be in a liability position, perhaps it would still be possible or not so difficult to do that. However, a group of contracts can be in an asset or in a liability position. So just some examples why a group of contracts can be an asset position. For example, you write a new cohort of business. It is a regular premium paying product, so the premiums are coming in over the coverage period, and you have rather high acquisition costs at the beginning. That would lead in the beginning to a group of contracts in an asset position, and when the actual claims come in, or as the premiums are paid, these positions can come back into a liability position. What is so challenging around that is that you have to allocate these different cash flow components like premiums received, premiums receivables, acquisition cash flows, insurance payables, your liability for incurred claims, and the liability for remaining coverage to the level of the groups of contracts. So the difficulty is here, for example, that the groups of contracts is a completely new concept. You know that, I think Massimo already briefly explained the concept of annual cohorts. You start under IFRS 17 with a portfolio of insurance contracts. You then narrow down, and you split up into annual cohorts, and then further in groups of contracts according to profitability. And you would then need to really allocate the related premium receivables or the received premiums to these groups of contracts. And our observation is that for today, at least, the cash management systems, they do not, they receive their information from policy administration systems, but there is, and also the policy administration systems further provide information to your reporting systems. However, there is no link between the cash management systems or interface between the cash management systems and the policy administration system, so a backward link. So you cannot link these information today, at least most insurers cannot link these information about premiums receivables and groups of contracts. So that would require a lot of additional investment into your feeder systems, and that would take a lot of time and a lot of resources, a lot of money. The question is also, what benefit would that really provide for users of financial statements? We think that this is very low, the benefits of seeing groups of contracts in an asset and a liability position, because it does not give you any information about a kind of overdue premiums or something like that. That is nothing that a user of financial statements can see here, but it will cost the preparers a lot of money to implement. So there are two different potential concepts out to solve that issue. So either something that the presentation can be done on rather on a portfolio level than on a group of contracts level. The idea behind that is that on a portfolio level, it is hardly ever possible that a portfolio is in an asset position, and hence this whole topic would be solved. However, others think that there are more complex topics, and the presentation or the information content of showing all the old balance sheet items still under IFRS 17 makes more sense. So both approaches would pretty much solve the issue of presentation as it is described currently under IFRS 17, and would make implementation much more easier than it would be according to IFRS 17 paragraph 78. However, that is not the only presentation issues. There are some other presentation issues, like the identification of non-distinct investment components. I don't want to go there too much into detail, but you know that a non-distinct investment component is something you have to deduct from your revenue. So it is not a component that is distinct from your insurance contract, but it would be reducing your insurance contract revenue. That would be it's defined in the standard as the amounts that the policyholder would receive, even though the insured event has not occurred. And I think one of the very tricky parts of the non-distinct investment component is that it's not really related only to life business, but it can also be related to P&C business, to the property casualty business. So, for example, a no claims bonus would usually be fulfilling the definition of a non-distinct investment component. And so that will be very critical to identify these items, and only for presentation issues, as it has no impact on the bottom line. Perhaps we can move on to the next question. The scope of the variable fee approach, you know, there is the general measurement model under IFRS 17. Some also say there also you have to differentiate between the general model and the modified building blocks approach. And on the other hand, there is the variable fee approach. The assessment of which measurement model applies is done on a groups of contracts level, so because that is your unit of account for recognition and measurement under the standard. And so you would then, on the groups of contracts level, assess whether the criteria as defined in paragraph B101 of the standard are fulfilled. And the criteria actually say that the variable fee approach contract is basically an investment or substantially an investment-related service contract, and it defines what criteria must be fulfilled. So first of all, the policy holder or the contractual terms must specify the policyholder participates in a clearly identified pool of underlying items. Second, the insurance entity must expect that the policyholder receives a substantial share of the fair value returns on the underlying items. And third, the entity must be expecting that a substantial portion of the changes in future cash flows or amounts paid to the policyholder will vary with the change in fair value of underlying items. So the critical item is that we have many gray area or some gray area cases of contracts also in Europe that are working very similar to contracts that fulfill these criteria, but that have some issues that could drive them out of the variable fee approach, and as such there would be cliff effects would be occurring because you apply two different measurement models. I think the main issue is the first criterion, that is this contractual specification of the policyholder participation in underlying items. Here the main question is the enforceability. So the standard says that the policyholder participation must be enforceable by law. So if the policyholder does not receive a certain participation, he can take legal actions, or the regulator might take legal actions against the insurer. So that is quite a requirement, and that would usually require that the policyholder participation is really defined in the contractual terms, or by regulation, or by law. However, there are contracts where this policyholder participation is less clearly specified. However, an appropriate participation is rather based on a constructive obligation. So the insurer has paid certain, or let the policyholder participate in a certain range over the past decades, and as such created some expectation with policyholders and created a constructive obligation also to do that in the future. So some question here is, can one really use constructive obligation to argue that there is this link to underlying items? That is especially critical for gray area cases in Europe. And second topic that is more perhaps a practical approach is on how do you assess the second and third criterion. It is based on your, as I said, the entity's expectation that the policyholder receives a substantial share, that the payments to policyholders vary substantially with the underlying items. So the question here is, does that need to be done on a quantitative basis? So do you really have to make a quantitative analysis, or is it more qualitatively? So do you just assess how does the contract work, and should it generally fulfill these criteria? We would, or most insurers would rather argue qualitative assessment should be sufficient, because otherwise it could be quite complex, and similar contracts could then be potentially smaller contracts might not fulfill the criterion, larger contracts might fulfill that. So we think the qualitative assessment would be quite helpful here. That's with regard to the scope of the variable fee approach. And that brings me to the last topic. That is quite an interesting one also. It's the insurance acquisition cash flows. And if you have followed the meetings, perhaps of the Transition Resource Group of IFRS 17, it was already discussed there in February. So the problem is that you have a short duration P&C contract, for example, with a 1-year coverage period, and a high initial or new business commission paid to an agent or a broker. And at the subsequent renewals of the contract, the agent or broker receives a lower renewal commission. Generally, how an insurer is pricing such a contract is there is a rather stable premium payment that takes into consideration the expected contract renewals, and as such, it is the pricing takes into consideration the initial commission and the future lower commission payments. The problem, however, is that then in the first period, usually the pricing is not so much higher to fully absorb the initial commission. That can lead to the effect that the contracts, the new contracts written in the first year, so the new business, is onerous at inception because the premium is not sufficient to cover expected claims, expected costs, and expected acquisition costs of these new contracts. However, at contract renewal, these contracts would then be profitable. So one question was, shouldn't one not be able to allocate these excess commissions, or the part of the commission payment at the first year that is an excess commission, to later contracts? So that was a question that was raised to the TRG. They said, no, that would not reflect economics. However, we think that this is wrong, really reflecting that in the first contract does not reflect the economics, because first of all, the pricing of the contract reflects the expected renewals, and second, under IFRS 15, the costs for acquiring a contract can be amortized over the expected contract renewals. So we think that there is a major inconsistency between IFRS 17 and IFRS 15. The IASB always intended to have two standards that are basically, or in many cases, in many instances, consistent. So we see an inconsistency here. We think that it could result in new business becoming onerous, where it is from an economic perspective definitely not onerous. I think that is an issue that should be highlighted, or could also be highlighted in a case study, and also in a simplified case study towards EFRAG, that this result is really counterintuitive and is also inconsistent with the treatment under IFRS 15. Especially, it gets very odd because if you think about contracts that could fall into IFRS 15 and IFRS 17, like fixed fee service contracts, the insurer has a right to either account them for under IFRS 15 or under IFRS 17. And so if you consider them, if it is under IFRS 17, you have to recognize the acquisition costs if it's a one-year contract in the first year. Under IFRS 15, however, you could recognize them over the expected renewals. I think that is quite an odd outcome and should be highlighted. So that's it, I think, from my side. And then I hand over back to Olaf and Philippe.
Thank you very much. I think we've just got one more topic from Harm, I believe, and on hedging. But Harm, I'm afraid I'm going to have to ask you to speak very close to the microphone, even if it's uncomfortable, because otherwise it's very difficult to hear.
Yes, can you hear me again?
Yes, but
Yes.
A bit closer, thanks.
Yeah, let me shortly cover the last topic on hedging, so that we still have some time left for probably for questions. On hedging, the key issue is that where IFRS 17 deals with the insurance liabilities and has different accounting elements where use is made of the P&L, other comprehensive income, and the contractual service margin. It basically does not deal with the hedging related to it, which is, in the case of derivatives, covered by IFRS 9 and may result in a number of accounting mismatches. And in a very narrow area, IFRS 17 accommodates this hedging, but that only relates to derivatives that cover some of the guarantees in products that fall under the variable fee approach. In that case, the accounting can be matched so that you have in the profit and loss account both the change in the guarantee and the change in the hedging derivatives. But again, that only applies in the variable fee approach. So that there's a couple of issues here. One is that if you have products other than the variable fee approach, there is no such accommodation at all. Secondly, this only applies in the variable fee approach where hedging is applied with derivatives for guarantees and not the broader concept of hedging. And thirdly, the hedging accommodation for the variable fee approach only works prospectively, so it ignores the history, where if you have build-up results under hedging in the past, you basically have to reset that at the transition date. So overall, that means that whereas there is some accommodation in IFRS 17 for hedging in the variable fee model, that is quite narrow. And there are many other examples where hedging is applied economically, but does not get reflected in the accounting under IFRS 17, and therefore, basically, hedging that economically reduces the risk exposure might give additional volatility in the accounting, and that is why there are examples being shown where basically further hedging should be allowed, so further than what is currently in IFRS 17 and further than the hedge accounting that is possible in general. And maybe I should leave it there, Olaf, in the context of time.
Thank you very much. I think now we would remind people that if you have any questions, to send them to us. The only way to do that is via a message to Insurance Europe as the host. You should be able to see it on your list of participants. I think if you click, you can send us messages. We don't currently have any questions, so I don't know if that means that the speakers all explained all the topics so well that there was no need for follow-up, but we would welcome some questions. Yeah, we had one question is, can we have a copy of the slides? We will be making the slides available on our website after the end of the webcast. Yes. If you go to the Insurance Europe website and you search for the webcast or IFRS 17, you should find it quickly. Well, I think I will just ask one of the speakers, because there are several of you who are part of the TRG, because we've talked a lot about the European process. I think it's probably worth maybe a very brief explanation of what the ISB is doing, in particular with the Transition Resource Group, what that is and what its purpose is, and maybe just a bit how it differs from what's happening in Europe, which is an endorsement process. So maybe Joe, because I know you're on the TRG, maybe you can just provide a very quick overview of that.
Yeah, happy to come in on that. I think the Transition Resource Group and the ISB are positioning it very firmly as dealing with matters of interpretation only. So they are saying the words in the standard mean, X, or they mean Y, as that's our intention, and that's how the word should be interpreted. If there are issues, and there have been a number of the issues that we've discussed today, like the receivable point, like a number of the issues on reinsurance, the acquisition cash flow point, the ISB have considered, and the staff position on the TRG is what the standard says is clear. And there isn't an opportunity, which I think is disappointing, to say that actually, yes, we all agree that what the standard says, for example, on reinsurance, yes, we can accept that what the standard says is leading to a mismatch that doesn't represent the economics of a business. What's disappointing in the operation of TRG is there's not really an opportunity to then say, well, what should we do about that? They are trying to close down the issues as much as possible, and there doesn't seem to be an appetite to address some of the issues where there's operational complexity for not much benefit, or where the interpretation of the standard, when you look at it in practice, is not making sense. So from my perspective, that's somewhat disappointing. There is a paper around some of the implementation issues going to this month's TRG, but again, I'm not finding that the ISB are trying to close these things down, say, well, it's up to you to find a pragmatic solution, not really providing any help or guidance. So it's definitely a good group. It's got a lot of advantages in bringing together preparers and preparers from outside Europe, and a good forum for discussion. But I think increasingly the preparer members are feeling a little bit frustrated that there's not more of a willingness to acknowledge that where, even though it is what the standard says, it doesn't actually make sense in practice. So I think it's important, and we are, collating and keeping track of those examples. Massimo, I wonder if you might want to add your reflections.
I agree with you, Joe, in the sense that we feedback ISB on the first meeting, and let's say the outcome of the first meeting was very similar to your summary. So especially we saw them quite close in discussing items or issues that are clear in terms of wording, but that create several operational challenges with the insurers. And we try to emphasize the fact that these second kind of issues are very important for us. And especially, for example, the focus on the implementation challenge is one of the areas, one described by Patrick, the presentation part. So we expect to discuss this topic also next week in London for the second meeting, and so let's see what would be the outcome. To be honest, one of the challenges in general of IFRS 17 is that we have to design our implementation project, but at the same time we have also this technical discussion going on at PRG level, and so there is also the risk and or the opportunity, depends, that part of the design will be modified according to the outcome of TRG. And so this is an additional element of complexity in the IFRS 17 program, because let's say the design is not fixed, because we have a lot of ongoing discussion at TRG, and depending on the interpretation and the discussion we will have at that level with ISB, with the auditors, we may end up with some different outcome compared to the initial expectation in the single implementation program.
Thank you. We still do not have any other questions, so I think unless one arrives by the time I finish wrapping up, we will finish a little bit ahead of schedule. But I would like to thank all of those who listened in, and of course all of those who have helped prepare this and speak today, the speakers. And if people have further questions, they can contact Philippe Angelis from Insurance Europe, or indeed, of course, your own associations. And we are working together on following the IFRS 17 and all other reporting matters, and indeed wider regulatory matters that impact the insurance industry. And we will be following up on those issues. So since there's no questions, I will wrap up and thank you all again. And indeed, I hope as many of you as possible will take part in the simplified case study. And certainly best of luck in your preparations for IFRS 17. Thank you. Bye-bye.